It is my pleasure now to introduce Jeff Clark, and he's the senior analyst over at goldsilver.com. Quite vocal also on Twitter. That's how we got in touch. We met each other. I think we met each other in Spokane or Coeur d'Alene at the Silver conference, Jeff. We bumped into each other there. And I really appreciate you taking the time this morning. Highly appreciate it. I know it's a little early still, like you're also on the West Coast. So, but I do appreciate you making the effort, and thanks for coming on. Really interesting presentation topic, M&A in our sector. We've seen quite a few transactions, and I'm curious to hear from you whether the trend will continue.
Well, thanks for having me, Kai. It's great to be back with you. I'm honored that you asked me. So I figured what's really happening right now in the industry that would be the most useful for investors. And for me as an investor, I'm an investor too. And I believe we're on the cusp of another major cycle in M&A, mergers and acquisitions. And of course, that can be beneficial to us investors if you own the companies that get bought out, right? Premiums at 30, 40%. Even if the stock goes nowhere for a year, all of a sudden you can have a 30, 40% gain if that happens. So, okay, so here's what I'm going to talk about. I'm going to talk about the production dilemma. That kind of underscores why there is an M&A cycle that's heating up again right now. I have some hints that'll tell us what we can expect in this cycle of M&A from the last one. I'll show you that M&A is actually already heating up, why it's a prime time for us as investors to focus on acquisition possibilities right now, how to identify those candidates, and then at the end, I'll give you my list, maybe a dozen companies that I believe are good candidates for actually getting bought out in our industry. So why are global gold reserves down? I think a lot of people in this audience will know that global gold reserves have been falling for years. So why is that? Because this point kind of underscores why there could be another M&A cycle heating up. Well, the first reason is because companies since 2013 have been focused on survival, not on exploration. A lot of funds since 2013, you may recall that's when there was a crash in gold and silver. All of a sudden, I mean, literally within one quarter, companies were rendered unprofitable because of the price. So since then, there's the quote from David Garofalo. He used to be the CEO of Goldcorp. He's now Gold Royalty. But he says for the past decade, the gold industry focused on strengthening balance sheets and paying dividends, not exploration, which resulted in a depletion of reserves. And the point here is if there's lower gold reserves, well, production's going to be obviously lower, which means majors are going to need more ounces. Producers are going to need more ounces. There's a second reason, and that is high grading. High grading is basically the concept where when prices fall, in order to stay profitable, a mining company will go mine the higher grade portions of their deposits in order to continue to generate, revenue that's positive. But the problem with that is it sacrifices the long-term viability or the economics of a mine. This little funky table here shows the blue dots are the companies that have been grading above their head grade. So they're high grading. The companies below the line, the black dots, have been not high grading. So 60% of miners since 2013 have been high grading. The problem with high grading is that when you go back to try to capture the low grade portion of the mine, that the economics on that may not be feasible. It may not be viable to actually still capture that those ounces because pardon me, it's not profitable to do so anymore. So this is a contributing factor as to why reserves are down and production is falling. Number three, as I think many in this audience know, ounces are getting harder and harder to find. There's been a substantial decline in major gold discoveries, as this chart shows. This is major gold discoveries going all the way back to 1990. You can see the trend is clearly down. And look at the yellow line there. That is gold exploration budgets. That's how much capital has been put into looking for gold discoveries by the industry. Look at the big spike in 2011, 2012. Look at the huge amount of capital they poured into looking for more gold and silver deposits. So that led to a big jump in discoveries, right? Because they were putting more money into it. No, discoveries kept falling. So this is a very real issue the industry has to deal with. That decline in discoveries is actually accelerating. It's picking up speed. These are the major gold discoveries during these periods. So from 1990 to 2011, there were 253 major gold discoveries. From 2012 to 2018, there were just 25. Since 2019, there have been no major gold discoveries. This is a great quote. The severe lack of new major discoveries over the past decade is a result of companies focusing on advanced stage assets and known deposits rather than searching for new discoveries. Also, the decline in the quality of ounces that is in those discoveries is projected to continue. This research shows the number of unprofitable gold mines. Last year, 5% of all gold major producers, actually not majors, the entire gold industry. If you're a producer, 5% of them were unprofitable. 5% of all gold producers last year could not turn a profit, even at 1800, 1750 gold. The catch is that trend is expected to pick up steam. By 2026, they're estimating 10%. It's going to double the number of unprofitable gold mines in the world. This is a good quote. Due to a decline in ore grades and higher costs, world gold production is projected to fall at an annual rate of 0.8% through 2026. As a result, there will be more mine closures and lower gold production. It's actually worse still. This funnel shows you those total of the 278 major gold discoveries I showed you earlier. There they are. Go down the funnel. Okay, how many have 10 million ounces of those 278 major gold discoveries? Just 30. Of those 30, how many have 1 gram per ton grade or higher? Just 9. So of those 278 major gold discoveries, only 9 of those discoveries, 9 deposits, have a grade of 1 gram per ton or higher and have 10 million ounces. And here's a good point there on the left, the bullet points on the right. Some mines will never be developed due to significant political or technical challenges or have a long road to production. I can think of a couple examples right off the top of my head where that's true. I'm sure Kai can too. Production from existing mines will begin decreasing in 2022. This is from an analyst in the industry. I think it's correct. The conclusion to that is majors desperately need ounces. Okay, so if we're right that we're going into a new M&A cycle, what can we expect? Well, the last cycle can give us some hints. Here's the amount of cash that was spent on acquisitions from 1990 to 2000. You can see it was 27 million. There's 27 billion. From 2000 to 2011, it was 159 billion. And there were over 1,000 acquisitions in the mining sector during that period. Now, since 2011, 2012, it's really dropped off. And now we're starting to pick back up again. If we have another M&A cycle, if we're right about this, we can expect to see a lot more cash going into buying companies out. Here's another hint. The growth in reserves has been driven by acquisitions. M&A accounted for 92% of the growth in reserves in the last cycle. Now, this chart's kind of odd looking, but look at the 2 blue bars on each end. So in 1998, there were 482 million ounces in gold reserves. By 2011, that number was 959. Okay, so how did it go from 482 to 959? Well, look at the, let's see, the second black bar there from the left. You can see less production, so 484. So basically during that period, the industry mined out all of their reserves. All of their reserves were mined out in that period. What is that, 23 years? Okay, so how did they replace it? Well, the next black bar shows you they added, from brownfield explorations, in other words, producing companies that are exploring and finding ounces near their existing operations. Then you add in greenfield exploration. That's where they're going out beyond where there's known gold deposits. So you can see if you add those two things together, they basically replaced what they mined out in that period. So where did the growth come from? Well, that's your last black bar, 440 million ounces. That came from M&A. M&A accounted for the bulk of the growth in reserves between 1998 and 2011. So if we're in another M&A cycle, that is going to be very beneficial for us as investors. Okay, I can give you some data here that shows that mergers and acquisitions is already heating up in the gold sector. You can see the first table there, M&A deals in last year. The quarterly average was 9, but in Q4, there were 11 deals. The ounces acquired in the next table there last year, the first 3 quarters of the year were 9.1 million ounces, but in Q4 was 8.9 million ounces, meaning almost half of all the ounces that were bought up in the industry last year occurred in Q4. Here's some more insight. This is another great quote. Majors had to acquire 30% of their reserve ounces through acquisitions just to stay flat, just to stay flat. So they are going to need to buy ounces. As a result, it is highly likely we will see more acquisitions in 2022. Another good quote there from David Garofalo, an M&A cycle has only just begun. It will be a record year of mergers and acquisitions. He made that quote a month ago. Okay, so why is it a prime time for us to focus on M&A in addition to everything else I said? Well, first of all, companies are cash rich. They are cashed up more than they have been in a long time. The higher gold price obviously has helped. They have stronger cash flows now. And number 2, their balance sheets. They've really cleaned up balance sheets from all the mistakes they made in the last cycle. You can see their net debt has fallen by over 50% at the 15 largest gold companies. Number 2, analysts are ready. COVID restrictions are easing, so analyst tours are going to increase. That, more analysts getting out and looking at projects, that's going to help. In 2020, I was on 0 analyst tours that year. I don't know what that was for Kai, but I bet he's getting out more now. So are all analysts, right? Number 3, the industry is gearing up. You're seeing the word growth reappear in a lot of management presentations and talks and things like that. And look at this, gold exploration budgets were 43% last year. That's a huge jump in 1 year in terms of the amount of capital that's going into the ground to look for more gold. But the biggest point of all this, the biggest reason is majors are going to need ounces. And the great thing about it is it's not dependent on higher gold prices. We're not betting on these companies, these M&A candidates, that the gold price is going to go up. That'll help, of course. But the main issue is majors need ounces. That's what's going to drive this cycle in M&A. Okay, so how are you going to identify what's a good M&A target? What's a good company that might get bought out? So Kai and everyone, which chocolate chip cookie would you rather eat? The ones on the left or the ones on the right?
Well, I prefer the chocolate chip. I'm a chocolate guy, so left, please.
Yes, there you go. Well, guess what? So do the majors. They want to focus on big and rich deposits. And so that's what we want to focus on. You want to look for, in my opinion, Kai might have a different opinion, but in my opinion, you want to look for a minimum of a project that can produce or is producing 100,000 ounces a year and has a 10-year mine life. That's kind of the minimum for me. Now, why is that? Well, pretend you're the CEO of a major gold producer and you're producing 1 million ounces of gold a year, and you need to replace 1 million ounces of gold a year. So what if I came to you and said, Mr. CEO, I have a deposit here that can produce 50,000 ounces a year for 5 years. That is not going to attract you. That is not going to excite you. That doesn't move the needle for you. They do need big and rich deposits. They're not going to be interested, at least the majors won't be interested in anything less than that. Now, some of the smaller guys will get bought out by maybe mid-tiers or something like that. But in my opinion, you want to focus on the big and rich stuff. Number 2, you want to try to look for companies that have below average costs. This shows quarterly all-in sustaining costs for the gold producing industry. You can see it's over 1,000 now. It's not quite updated, but we're still up there where it is now, especially with inflation moving higher. So if you can find deposits that either are or are projected to produce below $1,000 an ounce, well, that's more attractive to a major. That means the margin's going to be higher. Number three, in my opinion, you want to focus on near-term production-ready projects. As I think most of this audience knows, it's 10 years basically on average from discovery to production. So again, you're that CEO, and I tell you about this 50,000 ounce gold producer, and I come along and say, oh, and by the way, it won't be producing for 5 years yet. Well, that's not going to do a lot for you as a major CEO gold producer. So look for projects that are near-term ready, meaning in year 9 or 10, they're 1 to 2 years away from actually going into production. Number four, this should be obvious to most people. You want a pro-mining jurisdiction. Majors do prefer political certainty for the most part, and so should we. So that 50,000 ounce gold project I told you about, would you rather it be in Quebec, or would you rather it be in, well, I don't want to be negative, so we'll just say somewhere in Africa. And there's another advantage to that. If it's in Quebec or Nevada or somewhere really strongly pro-mining, you're probably going to get a higher premium. This is a well-established fact. Projects in pro-mining strong jurisdictions get a higher premium than those in risky jurisdictions. And number five, this was an interesting comment when I read this from David Garofalo. Companies will scoop up more single asset players. And I thought, wow, that is really true. So if you're a company that has a project in, one in Canada, one in Nevada, one in Mexico, and one in Finland, let's say, it's much more attractive to a major to buy, one deposit, one project, instead of trying to buy a company. It's less complicated for them. Again, they want ounces, not necessarily companies. So the bottom line to all this, to this strategy, is majors look for deposits with a long mine life in favorable jurisdictions with low costs, near-term production, with a preference for single asset companies. So that's our formula, that's our strategy. That's what we should focus on as well, since that's what they're going to be focusing on. And here you go, ladies and gentlemen. These are the ones that, just in my opinion, I think are good candidates for being bought out in the next year or two. Gold Resources there. Number one, that's a big silver deposit that's growing, very aggressive management down in Mexico. It's actually a silver deposit, not a gold deposit, although it has some gold in it. Benchmark Metals, very aggressive schedule this year. They're going to have a new resource estimate coming out next month. So timing could be good there. They're going to go right into a PEA after that. So they're going to go on the M&A target list after that resource is out next month, in my opinion. Silvercrest Metals, big, rich silver deposit down in Mexico with a very strong management team. They'll be in production by the end of the year. Ascot Resources with Scotty Resources, Kai pointed that out to me. Scotty's properties actually border Ascot's. And so someone could come along and just say, well, the trend is all the same, so they just might buy both resources, or excuse me, both companies. Ascot will be in production in about a year. Maritime Gold, Kai did a great presentation there. Maritime, the site visit there. They'll be starting production here this year. Artemis Gold, huge gold deposit in Canada, 8 million ounces. They're in permitting right now. They should be starting construction by the end of the year. Same with Marathon Gold. They'll be starting construction by the end of the year. They have about 2 million ounces, but it's growing. Skeena is an obvious target. The only thing with Skeena, I might want Kai's opinion there, but the valuation on that is pretty high. So there might, some majors might balk just because the valuation is so high, but that's a big deposit. It's going to have to be bought by somebody eventually. Gatos Silver is another good one, silver producer in Mexico. The great thing about Gatos is they are one of the companies that has the highest revenue coming from silver itself, higher than almost anybody else in the industry. So they have great leverage to silver. There's going to be a silver company out there that's probably going to buy them, in my opinion. Wesdome Gold Mines is another great one. They're an existing gold producer. Silver Lake is an existing silver producer in Australia. That's a good one. I put GR Silver on there. They're not near-term ready. They're still an explorer for silver down in Mexico, but they are just ridiculously cheap right now. And they're finding some very high-grade stuff. So at some point, if they keep going, I think they're going to be an M&A candidate as well. And there you go, everyone. If you want to follow me, if you want more information, I do write for silverchartist.com. It's pretty inexpensive. I run a company fundamentals. The rest of the team does technical analysis. It's a lot of fun. Use that link there, silverchartistadvisor.com, if you want that particular price. I also work exclusively with Mike Maloney at goldsilver.com. If you've not seen his Hidden Secrets of Money series, it's awesome. Just watch episode 1. These are movie quality productions that he spent a lot of cash developing. They're great. Grab some popcorn and watch it. And if you want to follow me, I am on Twitter at The Gold Advisor. I do disclose all my personal buys there. So if you want to follow me, you can do that. So there you go. Hope that was useful. And thanks, everyone.
Fantastic, Jeff. Great presentation. Really appreciate it. It's like good insights into the thought process also of the majors as well. And let's get a bit of a discussion going here as well. And
Sure.
when I saw your presentation and when you shot it over the other day, and I got back to you with saying, well, Barrick just put out their resource update or reserve update, and they kept it at $1,200 per ounce. So they haven't changed it. So the same number as in 2020. Is that impacting it anything at all? Like, do you think is that why they're so hesitant? And maybe, sorry, it's just a bit long-winded here. Bristow apparently was just on BNN saying that the M&A activity in the gold space was over the top in recent months. So how do you interpret that?
Is it over the top or is it just getting started?
No, I'm wondering if he means valuations. He didn't say any names or anything, but I'm wondering if valuations like Great Bear or Agnico and Kirkland Lake merging. And I know Barrick had a toehold, at least in both transactions, and got snubbed. So I'm not sure if there's bitterness to it as well.
Yeah, right. Good point. Right. Yeah, there are some very high valuations out there right now. Great Bear, Skeena, there are others, so that's possible, but that's not a result of M&A. That's a result of, the gold price moving up, investor interest coming more into the sector and driving up valuations a little bit higher. So I think it's inevitable that there will be some M&A. Maybe the premiums are not 40%, but they're 25% or something on average. Who knows? But I think the reality is, bottom line, majors need ounces, right?
Absolutely. Barrick is sitting at 69 million, and that's calculated at $1,200. So I'm not sure how that's split up between the mines, but it's just interesting to see that they're using such a conservative approach.
That is very conservative. I did see a data point. I wish I could find where it was or who did it, but they listed all the price assumptions for all the gold companies, and most of them were around, I believe it was 1,500. I don't know if you have seen that.
I don't have that data point, but I was looking for something like I was going to look for something like that because I find that interesting.
Yes.
Like, how are they calculating their reserve and resource models? Because that sort of dictates the pressure on M&A as well. Like, how is it looking at a higher gold price?
Well, they want to be conservative, because if the gold price does drop, if there's a stock market crash, for example, and the gold price takes a temporary dump, they don't want to all of a sudden have to face that reality that, oh my gosh, our reserves are less because the price is below what we calculated at. But that said, $1,200 is pretty conservative in the current environment. I think 14, 15 is much more realistic.
Yeah, I think so as well. So I'm curious, like, what Barrick is doing next. Like, they have been pretty passive, actually, in the last 24 months. They restructured their deals with Newmont and on Nevada gold mines. But other than that, it's been fairly quiet. So I'm curious to see what is going on there. Also, I'm not sure if you heard anything of what Agnico is up to now that the deal with Kirkland Lake is done, what their next steps might be. Any speculation on that part?
Well, that's a good question. No, I don't follow the producers as closely as I do the explorers and juniors, but boy, I sure like Agnico Eagle. It's one of the stronger gold producers in Canada, right? They have a great technical team, very experienced. I met them, years ago when I was in are they in Toronto, I believe. So
Yeah.
I like that company. I like what they're doing. And they tend to be a little more on the conservative side too. I think that's probably fair to say. So I think they're a great company to hold.
Yeah, they've been punished quite a bit for the transaction as well. So I'm quite curious. Like, I got to look at the final numbers now, what it looks like valuation wise, but definitely they're top three gold miner in the world now. So,
Oh, I think,
good.
yeah,
Yeah.
definitely.
Couple comments on your presentation when you said single asset companies or single assets are attractive again. One thing I wanted to throw in there, it's also from an ESG perspective, it also goes the other way around. Because I think single, and maybe you can comment on that further, that single asset producers like a Torex Gold comes to mind or a K92
Yeah.
are actually on the prowl looking for assets as well. Is that something you can confirm as well? Do you think that might be happening?
You mean smaller companies looking for assets?
Yeah,
Is that,
like a Torex Gold. They're
yeah.
a single asset producer in a jurisdiction that's not 100% ideal, Guerrero, Mexico. Do you think companies like a Torex Gold would be out hunting for assets as well?
Oh, absolutely. Yeah. It won't just be the majors. But when it comes to the majors, what they might buy, it's probably going to have to be some of the things that I mentioned. But
Yeah.
absolutely, the mid tiers will be buying smaller ones. Smaller ones will be buying explorers or developers. So it all goes, it all falls in line. I think that's definitely going to happen. Those are two other good candidates that you mentioned. Yeah.
Yeah, fantastic. Like 1864 gold. Okay, so while this SF Online conference has been going on, like gold price actually has been increasing. It's great to see. Like I'd say it's all
Yeah.
us. Like of course we influence the gold price, right?
Yeah.
But like why do you think like and you follow it closely as well? Why do you think sentiment is still so bleak overall? Like we've seen lots of increase in exploration spending, gold price higher, quite a bit of M&A activity, but overall sentiment is just non-existent. Do you have an idea? Like, can you
Well, I
speculate on
think
that a bit?
sentiment within the industry is picking up because exploration budgets are picking up and increasing fairly significantly, right? Because M&A is picking up. So within the industry, I think they're bullish. I think where they're not bullish or less bullish would be outside of the industry, right? And I came across this interesting stat the end of the year in 2021. There was more capital put into the general markets, stock markets, last year than the previous 20 years combined.
Okay.
So no wonder the gold market didn't go that well. It was a risk. It was a risk-on environment. Hey, we're coming out of the pandemic. There's a vaccine and all this thing. It was, markets are forward-looking, right? So there was this whole thing where they could, investors were more optimistic. And so why do I need gold if inflation is going to be transitory? Why do I need gold if the economy is going to grow and speed up? So I think at some point that investor is probably going to come back into gold. I think some of them actually are. That's probably why we're up at the price we are. But I think that it partly explains why the sentiment was not in the gold sector last year.
Yeah, it's quite interesting to see like stocks like Peloton or even Facebook or so are being punished from the market right now. And I think that
Right.
401k money, like the tax-free saving account money, is starting to get scared and might be diverting. I think Barrick is up 7% today based on their announcement of a special dividend of another $1 billion.
Oh,
See
that's
that?
awesome.
So maybe you can wrap up with this actually with a question coming back to Barrick again and them issuing a special dividend of $1 billion. Would you rather see a dividend or do you want to see the Barrick go out and buy something for $1 billion?
To answer that question, I would want to know what their cash balance is and what their debt is. I think those two things would tell us if that's a good use of funds or not. And of course, they're one of the largest gold producers in the world, right? So they need to replace a lot of ounces. So, and I do like Mark Bristow. So
So let's take Barrick out of the equation. Are you pro growth or pro dividend? Oh,
well, for me personally, I'm more pro growth. I mean 90% of my investments are down the ladder. Explorers, developers, things like that. I don't own very many producers, so that's just my personal preference.
okay, same here. Like I'm more in the junior explorer space, trying to find something, then find an exit, obviously, either production or takeover.
Yeah, I'm more like Babe Ruth. I'm gonna try to hit more home runs, but I'll probably strike out more too. So
As long as you have with the batting average needs to be 20%, like 200 needs to be the average to actually be successful in junior mining. So I think that should be okay.
That's good.
Fantastic. Jeff, it was a great pleasure having you on SF Online. I really appreciate your time. What a fantastic presentation. Thanks so much for joining us.
Absolutely, Kai. It was great to be here. Let's do it again sometime.
Oh, most definitely. I'll get you back on SF Live and we can talk more, go back and forth more. Fantastic.
Okay, great. Sounds
Awesome.
great.